Now, when you take a loan, one of the first things you have to remember is you have to service it. Now, that was obvious, wasn't it? Of course it was. So how do you service a loan? You service the loan by repaying it in installments. And what are those installments typically called in the industry? Equated monthly installments. Equated because they are equal, monthly because you pay monthly, and installments because it is an installment you pay over the term of the loan. Now, why is it a monthly payment? Let's understand that. We have always taken the fact that it is a monthly payment for granted. The only reason why it's monthly is because our cash flow, our income, our salaries is monthly. And that is why it is called an equated monthly installment, or in common parlance, EMI. Now, what we have to remember is that you start repaying a loan after you take the loan. So the EMI starts typically after you've taken full disbursement of the loan. There are exceptions, and we'll talk about that in a minute. But in all cases, you will always notice that the EMI starts after you take full disbursement. So let's take an example. Let's take an example where you've taken a loan of say 10 lakh rupees at 8.5% for a term of 15 years. Now remember, a loan repayment can even go up to 25 years sometimes, 20 years. In fact, anecdotally, I should tell you, in Japan, loan repayments used to go to 100 years. Does it mean that most people lived for 100 years? No. All it meant was that if something happened and the person died, his family would take over the loan. Coming back to India, now you've taken this loan of 10 lakh rupees for 15 years at 8.5%. You might take all the loan disbursement in one shot. An example of when you would take it is typically when you are buying a ready possession house and you have to make full payment upfront. However, in many cases, we book a house in a project that is coming up, an under construction project. When you do that, you don't pay the developer or the authority from whom you are buying it all the money upfront. You pay as per the progress of the work. Now, when you do that, you take your loan disbursement also in installments. Let's take the example of the 10 lakh loan and the property is worth say 15 lakhs. So own contribution is 5 lakhs, which is the difference between the cost of the house and the loan you have taken, and you will pay that to the developer either as a down payment while booking or in progress of work as the building starts getting completed. The construction of the building progresses, you will get demands from the developer. When you get that demand from the developer, you will go to the lending institution and you as a lender will receive a request for a disbursement. That letter for disbursement, which is a letter from the developer, has to be backed by a request from the customer asking you to disburse. Now, does that mean that you will automatically disburse the loan? No, it does not. You will do a technical diligence where your technical person will actually go to the site and ensure that there is progress of work. Let's assume that that is there and now you are ready to disburse say 3,50,000 rupees out of the 10 lakhs. Let's assume this person takes the disbursement from you of 3,50,000 rupees on the 17th of March. He's not taken the full disbursement yet. The EMI assumes that you have taken the disbursement and you start repaying the loan. So we can't start the EMI, which then brings me to the second concept I need to talk to you about. What is the pre-EMI? It is the interest you pay prior to the commencement of the EMI on the portion that you have just taken as a disbursement. So in the instant example, you will pay simple interest on 3,50,000, which is the amount that you took as a disbursement, from the 17th of March onwards, which is the day you took the disbursement. Now let's assume 3 months later, your builder makes another demand on you and you come back to the lending institution and you as a lender get the second request for disbursement and you decide that you can disburse 5 lakhs now based on the demand, based on the progress of the work. So this happens say on the 5th of June in the same year. Now this person has been paying interest to you from the 17th of March on the first installment that he took from you, which is 3,50,000. On the 5th of June, the total amount he has now taken is the original 3,50,000 plus the 5 lakhs that he is taking now. Therefore, you have now given him 8.5 lakhs, which is the sum of these two figures. From the 5th of June onwards, therefore, he will pay you simple interest no longer on that 3,50,000 rupees, but now on 8,50,000 because he took another 5 lakhs from you now. This continues until, let's assume again for the purpose of this example, in November of that year, say on the 5th of November, he takes the balance 1.5 lakhs. When he does that, he has effectively taken the full disbursement. 3.5 on the 17th of March, 5 lakhs on the 5th of June, and 1.5 lakhs on the 5th of November. Now he owes you interest on 10 lakhs. But more important, an event has happened. He has now taken the full disbursement of the loan. When he has taken this full disbursement of the loan, he now has to start repaying the loan. But wait, what he will do first is till the 30th of that month, in the month in which he took the last disbursement, he will still pay simple interest. From December onwards, the EMI will start. Now the EMI has a component of interest and it has a component of principal. And over the 15-year or whatever term that you have taken, this payment of interest and principal will ultimately settle your loan down to zero. You will have repaid the entire loan, you will have paid the interest on that. That calculation, that method of deciding how much interest and how much principal goes into each EMI as you repay is called an amortization. And that amortization is represented by a schedule. What the schedule will show you is, let's take an example. Let's say you've taken the loan for 10 years. 10 years effectively is 120 months, right? So in the first month, which is in December in this particular case, you owe the lender, or the lender, as you as a lender, the borrower owes you 10 lakh rupees. You will charge him 8.5% per annum, which is 8.5 divided by 12 per month. And you will calculate the interest on that figure. That figure will be subtracted from the EMI which you will pay, and then the difference is towards the repayment of the principal for that month. Therefore, the opening balance in the following month is the original 10 lakhs minus this principal figure. How did we come to the principal figure? Because we calculated the interest on 10 lakhs for 1 month, took that upfront first, and whatever was left out of the balance EMI was towards the principal. Now, just as an aside, you will notice here that the principal amount is very small in the EMI in the initial term of the loan. The reason for that is that the interest amount is high. And the reason that the interest amount is high is because the outstanding loan amount is high on which the interest is being calculated. That is very important to understand. So typically, and I'm sure some of you have experienced this, after 2 or 3 years, a customer comes back to you and says, I've paid EMIs for 3 years. What is my outstanding amount? He will be a little surprised to see that the amount outstanding is not decreased significantly, because in the initial years, the charge to the interest is higher, the charge to the principal is lower, and therefore the outstanding balance comes down at a much slower pace. As you will see in this example that we've done, and it's an example which you in your Excel sheets can also do, as the years progress, as the months progress, you will see the component of interest come down and the principal component goes up. The only reason for that is because the principal component is coming down further, what is happening is that the interest charge is lesser. And if the interest charge is lesser, then the amount of principal within the EMI starts going up by default. This is a normal amortization schedule. Why do I say normal? Because there are 2 or 3 events that can happen which can change the way this is done. Although the principle in which it is done, the method in which it is done doesn't change. Let me give you those 2 or 3 examples. Let's take a situation where, supposing in the 16th month or the 26th month, a customer comes and says, I want to repay 2 lakh rupees. As a principal, I want to prepay the loan. A situation that all of us have experienced or will experience depending on where you are in your current roles. Now, when the person comes and makes a 2 lakh payment, what do? You strike a balance. You find out the outstanding balance at that month through this amortization schedule, and then in the bargain, you take out 2 lakhs from whatever principal is outstanding, because that's what he's paying you back. This also assumes that he has got no outstanding of old EMIs or delayed payment interest or anything. Because if there is, then in that 2 lakhs, first the amount will be recovered for those delayed payment and penalties. But in our example, there is no such delay, and therefore the principal comes down by 2 lakhs. So let's assume the outstanding principal is 7,47,000 at the end of say 25 months. What happens is the outstanding principal now comes down by 2 lakhs and is now 5,47,000. Obviously, two things can happen. Either the EMI continues to be what it is, or you reduce the EMI. If you continue with the EMI as it is, the overall term comes down because now he has to repay lesser principal. However, if he wants to continue with the term as originally planned, which is 180 months minus the 26 that have gone by, then the EMI must come down because now he owes you lesser principal. And so on, the amortization will appropriately change. The principle of amortization does not change. Now, there is one more situation where this amortization schedule takes a twist. And that is when and we will talk about this product when we talk about products, is when if for some reason the EMI is being increased or decreased during the term. The amortization is still the same. The interest will be calculated. The EMI is fixed, now changed to an up or down figure. And therefore, the principal amount being repaid is changed and accordingly reflecting in the amortization schedule. Remember 2 or 3 principles. One, whatever happens or whatever amortization happens, the outstanding principal on the last month has to be 0. If it is not, you've done your calculation wrong. Now, if that is so, then what is the balance amount you have received, which is the EMI multiplied by 180 months. The balance amount is the interest. Now, a little trivia here. What you will notice is that although the interest in the last month is supposed to be say 100 rupees, you might have recovered 102 rupees. There are 2 reasons for that. One, remember that the EMI is being rounded off typically to the next higher rupee. So you are recovering a little extra every month from him. That extra is reflecting in that 2 rupees that you've charged him extra for. Plus, you're charging him interest on those 2 rupees. Although the number is very minuscule, it still impacts the calculation. So we have a pre-EMI and we have an EMI. So the question that naturally comes to us is, as a lender and as a borrower, what should I do? Because sometimes if the project is taking 1, 2, 3 years, you're taking money and you're paying simple interest, but your principal is not coming down. You have choices. One choice is you can reduce the loan amount and start your EMI on whatever you have taken. The second choice, and many lenders offer that now, and I'm sure maybe your company does too, or the lender you go to does that, is that if you have taken, say, again in my example, say 6 lakh rupees, they'll start the EMI on 6 lakhs. And the balance 4, remember the original loan was 10 lakhs, the balance 4 lakhs EMI will start later. So you're actually now paying 2 EMIs, which are running parallel to each other. This way you start paying your principal back faster and not have to wait to pay simple interest for the period of the construction. Now, there is another important thing to remember here, that there are certain tax benefits for pre-EMI and EMI. Now, I'm going to give you the current tax benefits, but please remember, tax benefits could change at every budget. So, for example, today, when you pay pre-EMI, and there are certain conditions, that pre-EMI you can carry forward for 5 years and write it off against any income that you have from house property over equal installments of 1/5, 1/5, 1/5, 1/5 and 1/5. And the EMI, which has got interest and principal again, the interest component again is a deductible amount under various sections of the Income Tax Act, and the principal amount also under certain sections with limits and total are deductible. It is important that you keep yourself updated with what the tax benefits are. As a lender, you should know, because when your customer asks you, you should be able to explain exactly what the deductions and benefits he has and under what conditions. As a borrower, this is more important, because when you get deductions from your income tax and you don't have to pay income on certain amounts, then your effective rate of interest comes down. So today, if you're paying say 7% on your home loans, but on the interest that you have paid, this 7%, if you're getting a deduction, then your effective rate comes down. Now, the calculations will vary depending upon what tax bracket you are in, what other claims you are making under various deductions of Section 80. But the principle continues that when you claim deduction under any section of the Income Tax Act, your effective cost of the loan, the effective interest that you're paying comes down. And that is very important for you to understand from a cash flow perspective. Now, when we talked about EMI and pre-EMI, the question that obviously comes in our mind is, how do you calculate an EMI? The pre-EMI is very simple. All you need to do is to take the number of days, take the interest rate and apply it to whatever loan amount has been disbursed. But the EMI is a little more complicated. Remember from our arithmetic in school, any calculation of interest involves three parameters: the amount of loan, which is the principal, the term of the loan in months, and the interest rate that is being charged. Now, there are three methods I can tell you, from easy to tough, from the right way of doing it, of how to calculate an EMI. The easiest way nowadays, go to any of the websites of any of the lenders and you'll invariably have a calculator. You put in any of the three parameters, you will get your EMI. In fact, you can work it backwards somewhere, that if you think you can pay so much EMI at a particular interest rate for this term, what is the loan amount that you can get? So out of these four parameters, which is principal loan, interest rate and term and EMI, if you put in any three, the fourth one will get automatically calculated for you. That's the easy and quick way. The second method of calculating EMI is to go to an Excel spreadsheet and use the formula to calculate the EMI. Right? So you will put in various numbers and you will kind of, extend it, the formula, and you'll get your answers. However, I think as a lender, it's very important you understand how is the EMI actually calculated. Now, some of you in your lives in maths and all might have heard of a concept called geometric progression. So a person is repaying a fixed amount of money over a period of n months, n being the term of the loan. In our example, it was 180 months, 120 months, whatever you take. And every month he's paying you an amount. That includes interest and it includes principal. The present value of that is the loan amount that you've taken. So you have to discount this for interest 1 month, 2 months, 3 months, 20 months, 100 months, 120 months, n months. And that discounted value at the rate at which you are lending is the original principal amount. Now, if you remember geometric series from our school days, then there is a way to calculate what is the sum of these figures. There is a formula. What is available in the formula? The loan amount is available, the interest rate is available in interest per annum, and then the term is available in months. Therefore, you use these three, and there is a formula which is used to find the sum and discount it to today's value. That is the formula you are seeing on the screen, and that gives you the installment or the EMI. Now, if you understand this concept, then of course it is very easy and very correct to go into a website of a lending institution or to go to Excel sheet, as we talked about, because it's very important you understand the method in which this is being done. So before we end this discussion on amortization, I think there is one twist again which I would like to present to you. There is a specific constraint that applies, which is that every month, every term that you're talking about, the interest has to be collected. If you fall short on paying the interest amount for that month, what will happen is that the outstanding interest which is not being collected will actually get added to the principal, and there will be no money available within the EMI to set off any principal. For example, and a quick one here, 10 lakh rupee loan, supposing the EMI is 7,000 rupees and 6,000 goes towards interest, there is a principal of 1,000 available. However, if you only pay 4,000 and the interest is 6,000, you are short on interest by 2,000. When you are short on interest by 2,000, it gets added to the outstanding principal. At the end of the month, you owe 10 lakhs 2,000. The opening balance for next month is 10 lakhs 2,000. You apply the same principal. Again, you are not paying full interest. So the end of the second month, the outstanding principal now is inflated further from the original 10 lakhs to the 2,000 rupees from last month to another 2,000 rupees or 2,000 odd from this month. And actually what will happen is, if you draw a graph, you will see that the outstanding principal, instead of coming down, is actually going up. And unless you either increase the EMI or prepay a loan amount, this graph is only going upwards. It will never get fully amortized, which is against the principles on which amortization is supposed to happen. So you have to be very careful that you are not doing what is now called in this situation negative amortization. Amortization is normally positive because it brings the principal outstanding down. However, in this case it's negative. You will have to either reduce the outstanding loan As a lender, you will have to find a way to get that done, or as a lender, you will have to step up the EMI so that it not only covers the interest for that month, but actually starts bringing the curve downwards. You might have to increase the term unless the EMI is significantly stepping up for whatever reason. Now, this is purely a maths. At the credit module, we will understand how it applies as it comes to actually taking a credit decisioning. Who should be given a step-up loan? Who should not be given a step-up loan? We are not going into that. This is purely mathematics here.